And we wrote a paper in 1982 that said, okay, let's put all these things together. And we said, look, there just are too many problems here. We can slough them off one at a time and say the model's working okay. When you put them all together, it basically says this model's not working.
I'm Dan Richards. I'm talking today from the University of Chicago Booth School of Business, and I'm speaking with Eugene Fama, broadly acknowledged as the father of modern finance. Gene, one of the pieces of research that you're best known for, and one of the most influential and important, relates to some work that you and Ken French did years ago on the three-factor model, suggesting that, in fact, the traditional view that the only thing that predicted future returns was beta or volatility, in fact, was taking too narrow a glance. So let's talk a little bit first about what led you to kind of that research that you did with Ken French.
That's a good question. This is back in like 1990 when we first started working on this, and what the situation at that point was that the CAPM was still this one-factor market-only counts model.
Yeah, so volatility is the only thing that really
market volatility.
Right.
Was the only sensitivity to market volatility was the only thing that was the only measure of risk that you needed to know to describe average returns, and that was the dominant paradigm. But papers had been accumulating, showing that if you sort if you sort stocks on market cap, the model seems to have some problems. If you sort them on earnings price ratios, the model seems to have some problems. If you sort them on leverage, the model seems to have some problems. And we wrote a paper in 1982 that said, okay, let's put all these things together. And we said, look, there just are too many problems here. We can slough them off one at a time and say the model's working okay. When you put them all together, it basically says this model's not working. And so then the next year we put a paper out that said, okay, maybe you need at least two more risk factors to describe how average returns differ from one another. So we added a size factor, basically small stock returns minus big stock returns, and what came to be known as a value growth factor, which is the difference between high book-to-market returns and low book-to-market. High book-to-market value returns, low book-to-market.
Yeah, so basically the value premium.
So this model says there are three dimensions of risk. Exposure to the market, every asset pricing model, every risk-return story says exposure to the market counts. The CAPM, the original one, was one that says that's the only thing that counts. So we're basically saying at least two more sensitivities are important in describing how average returns differ from one another. And that's caught the attention of academics and practitioners, much to my surprise. I didn't think the original paper would be published because, as far as I could tell, there was nothing new in it.
Right. Well, what's interesting, of course, is that some of that work, in fact, has been the foundation of some of the work that Dimensional Fund Advisors, DFA, has done, with which you're associated. And in fact, its president, David Booth, wrote a fairly large check, I believe, that to put his name on the business school here at the University of Chicago. And so the DFA, I think, is probably one of the best-known firms that's taken that academic research and, in fact, commercialized it in their offerings.
Right. Their approach is based entirely on this three-factor model, and Ken French and I are involved in their product development, maintenance.
Now, what's interesting is when you take a look at the impact of size, the fact that smaller stocks outperform, shouldn't have been a surprise. If you look at the Ibbotson Morningstar Ibbotson data now, going back to I think 1926, it shows that a performance premium, I think, of 3% per annum over that period of time.
If you go back to 1926, from 1926 to 1963, the data only include NYSE stocks.
I see.
NYSE small stocks are value stocks because they're way below the median NYSE market cap, and in order to be listed on the NYSE originally, the listing requirement was basically right at the median.
I see.
So everybody below the median had fallen in value.
I see.
Basically means they were small value stocks.
I see. So there you've got a blurring of that line
You get a blurring
between
of this line between size and
Okay.
value. So that's basically what we tried to disentangle in this
Now, so let
93
me.
paper.
So let me.
So if you look at the size alone, controlling for value, that is not so big. The CAPM has a little problem with that, but not such a big one.
So it's the value. It's the
value
value.
that's a big problem because the CAPM thinks that value stocks are less risky than growth stocks.
And so, Gene, let me ask you. The last question is: you developed this insight. That there are three factors, not just one, that determine stock performance. If you take the view that the market, is perfectly efficient, is there a possibility that going forward that insight is going to be reflected in market valuations, and so that return premium will disappear over time?
It all comes down to, do you think it's risk or not? So do you think small stocks are riskier than big stocks? Do you think value stocks are riskier than growth stocks? Or to turn it around, to saying they're riskier is the same, have higher expected returns is the same as saying they have higher cost of capital. To me, it makes a lot of sense that small stocks and value stocks are riskier, and they have higher, as a consequence, have higher cost of capital and higher expected returns. It's like saying, because we now know that over long periods of time stocks have higher average returns than bonds, do we expect that to go away in the future? Well, you don't if that's a premium for bearing risk.
So I can understand how smaller stocks would intuitively be seen as being more risky. They're less well capitalized, more vulnerable to financing crisis. But value stocks, some would say, well, they should have a higher margin of safety, so they should be less risky rather than more risky.
No, that's not the way it works. Value stocks, if you look at their economic characteristics, tend to be stocks that are in some difficulty. So their fundamentals look good relative to their market values, but they look awful relative to book values. So these are basically companies that are kind of reorganizing a bit, getting things back in order. So they're not. On the other hand, the growth stocks tend to be highly profitable, expanding, all of that. So it makes sense to me that the troubled firms have higher costs of capital.